Hi, everybody. This is Michael Mandel, and this is the Not Podcast. And I'm here with Mark Fitzgerald from Affinius, and very excited to enter into this conversation today and talk about commercial real estate lending, about data, about the impact of data and technology on the industry, and what's going on in the commercial real estate market. So I'm going to hand it over to Mark, and why don't you tell us who you are, what you do, maybe what your favorite color is, and let's lead into this conversation.
Sounds great. Thanks for having me, Michael. I really appreciate it. And if you can't tell, my favorite color is navy blue. But yeah, I'm Mark Fitzgerald. I'm the head of our North American research team here at Affinius Capital. We have gross assets under management of about $64 billion, and we invest across the risk spectrum in capital stack, delivering both equity and credit investment strategies on behalf of our global institutional clients. So I've been with the firm for 11 years now, helping to build up the research platform and assist, in working with our executive team and portfolio managers on the development of investing strategies, as well as creative research to inform and enhance our investment processes.
Awesome. For those people listening who don't know the history of Affinius Capital, where did that come from? Where did this name Affinius Capital come from?
Yes, so we were previously USAA Real Estate Company, a subsidiary of USAA, and back in 2020 there was a management buyout of the organization, and so USAA is still a partial owner of the firm. But I think for regulatory purposes and other reasons, it made a lot of sense for us to go out on our own. We changed our name over to Affinius Capital, which is a Latin word for alignment, back in 2023, and to show that we are highly aligned with our partners.
Got it. Okay. Well, I was about to ask what it means, so now I know. I don't know why I didn't think to ask that before. Cool. So, Mark, you are an expert, or at least the expert, on this podcast about commercial real estate lending. So what's going on? We just had an interest rate cut. That's fantastic. I think maybe. Is it fantastic? What's that?
I think you heard cheers going up across real estate offices across the country.
Yeah. So I think as fantastic as it was, it more so would have been even less fantastic had it not happened, because everyone was expecting it. But how excited should we be? We're still a long way off from the practically 0% interest rate environment that we were in before. What do you see happening now with lending? It's a very broad question, but let's start off broad, and then we can dig in a little more off the back of this rate cut.
No, that makes sense. I'll start even broader. I think if we think about what the Federal Reserve was looking at when it made that decision on the rate cut, they track two key measures, right? Their key metrics are employment and inflation. And so I think what we have seen as 2024 has progressed is that employment growth has continued to slow. So we've got a new jobs report coming this Friday, but our trailing 3-month average employment growth is down to about 116,000. So, still decent, but well below, we've been averaging over 200,000 going back to early 2021. So we also saw a revision last month where the Fed knocked down the employment estimates, or the BLS, by 818,000 jobs. So again, that took total employment on that trailing year basis from 240,000 jobs to about 170. So still fairly strong employment, but not as robust as we previously believed, right? And a lot of these other, what tend to be historically leading indicators in the job markets, temporary employment has been declining. Job openings is trending down, although still relatively elevated. And then the quits rate came out this morning, and that has dropped off fairly precipitously. And so that tends to be indicative of slowing wage growth, because people aren't leaving their jobs for better opportunities, and thus reduced services inflation. So I think from an employment perspective, that's where what helped the Fed to get comfortable after seeing some surprises to the upside, I think, on the employment numbers earlier this year with those job cuts. The second piece being inflation, right? So that was stickier than expected in the first half of the year. The key measures being tracked, whether it's the consumer price index, is finally down to 2.5% increase on a year-over-year basis as of August. The Fed's favorite metric, which is personal consumption expenditures, that has now declined to about 2.2% on a trailing 12-month basis. And I think both of those measures are giving the Fed comfort that inflation is finally beginning to get under control. And I think also the fact where if you look at where inflation is happening, right, if you break out the non-housing sector inflation versus housing sector, housing is, or shelter is about 45% of the CPI measure and only about 15% of the PCE, but that's been running north of 5% still. And I think there's a belief from the Fed that, whereas initially it was thought, maybe bringing up rates, short-term rates, and what happened with mortgage rates, right, going over 7% would cause some downshift in the housing market. I think what's happened is there have still been some demand pressures and a lack of for sale inventory in the market, which has kind of kept housing high. So perhaps if we start to lower rates, that would actually start to get the housing market moving a little bit more volume, and start to bring down the cost of housing as well. But I think the combination of those two things, right, if you think about the softness in the employment markets and inflation getting under control, is what led to that 50 basis points decline a couple weeks ago. And what's really interesting is on the announcement, there was a downward shift in the forward rate curve as well. So now expectations are for another 75 to 100 basis points in 2024 and getting down to under 3% by the end of 25. So,
you think it's going to be that much cut in this year?
My crystal ball is as murky as everyone else's is, but that seems to be the way that what the markets are expecting. I think what's interesting about that is historically that would be very unusual without some economic softness, right? Usually when you see significant declines in the federal funds rate, that aligns with some softness in the economy or a recession, right? The initial cuts may come just prior when the Fed sees what's materializing, and then that tends to follow. So, but the flip side of that argument would be that if the natural Fed funds rate is closer to 2.5 to 3.5%, I think the neutral rate is that's where the market believes it should be. And so maybe moving closer to that from a less restrictive monetary policy, particularly as some of the fiscal tailwinds are beginning to fade, might help to soften and lead into that slower recovery.
So how much do rates have to be cut to make commercial real estate feel healthy again, and to have these borrowers who have their loans coming due not be completely underwater here? Like, what do you think we need to see happen?
Well, I think if you look at what's happened already, sentiment's been improving. I would say even in the 4 to 6 weeks ahead of the rate cuts, we were seeing increased activity from our lending business and on the equity business, right? The biggest challenge the last couple of years has been just rate uncertainty, and as a result of that, sort of a wide bid-ask pricing gap in the marketplace. But if we look at what's happened with the 10-year Treasury, more of a benchmark for pricing and cap rates in our space, that's fallen about 100 basis points over the last 6 months. We are seeing, like I said, activity pick up. The cost of debt is declining, which is enabling more deals to refinance, more deals to pencil in that bid-ask gap to begin to close. I think we've seen a significant narrowing of the gap between private and public markets pricing over the last couple of months. And so I think all of those factors are converging right now to create more robust demand from borrowers and generate activity. But to your point, certainly we're not fully out of the woods yet. And a lot of the floating rate deals that were originated at the peak of the cycle in 21 and 22 are still challenged today from a debt service perspective, given where rates are, short-term rates are.
Right. I mean, I think positive sentiment is great, but if you've got a floating rate loan that you on a multifamily property underwritten at virtually no vacancy and incredibly low cap rates, where frankly the vacancy rate is probably still low, but you still have a challenge, right? I mean, how much further do we need to get for those borrowers to be able to refinance and not lose their shirt.
No, I mean, I think it's going to obviously vary on a deal by deal basis. But to your
Yeah.
point, I think the fundamentals have remained fairly healthy. We've seen a slowing of rent growth for sure, and a slowing of demand. But generally speaking, throughout the cycle, this has been more of a capital markets cycle over the last couple of years, right? The slowing of employment growth may be indicative of a more general slowdown, but I think overall the markets have held up in what we've seen, if anything, particularly in some of the in favor spaces like multifamily, industrial, has been elevated supply levels have been the part that has been a challenge to fundamentals over the last couple of years. And given that it was very challenging to make deals pencil over the last 18 to 24 months for new developments, we're going to start to see those construction pipelines reduce significantly as we look out towards 2025 and 2026.
Yeah. And, I presume for you as a non-bank lender, there's been opportunity in this market. Maybe you could speak to that, but also speak to what, does that opportunity go away as the banks come back and start lending again? And how do you see the impact of that?
Yeah, no, I think that's a great question. Probably two separate trends that we should talk about from that perspective. One is the secular trends that we are seeing in terms of really since the post-GFC environment, right, in terms of increased regulation on some of the traditional lending sources, right? The Basel III Accords in the banking space in particular have created a situation where, capital requirements on direct CRE lending, particularly what they call HVCRE or high volatility commercial real estate for transitional or construction lending, has created very high capital requirements and even higher for some of the global systemically important institutions. So what is capital? It represents, the value of a bank's equity instruments that can absorb losses, but increased capital requirements reduce profitability, right? It's you have to hold more capital against those loans. And so we see that, the banks today are fairly well capitalized, but because they have to hold additional capital against these loans, versus if you look at capital treatment for lending to warehouse lines for debt funds, for example, get much better capital treatment. I think we've seen over the last 10 to 15 years that's fueled the rise of the non-traditional lending space and debt funds in particular. Mm-hmm. So that secular trend should continue, and we are looking at implementation of the Basel endgame here over the next 12 to 24 months, which will only further that story. I think if you look at the point in the cycle, certainly I think some of the other lender sources are probably dealing with some balance sheet issues and looking at whether you're looking at office exposures, but securing takeout in today's environment, particularly for those transitional loans, is a challenge and offers opportunities for fresh capital to come in and restructure the capital stack. So I think debt funds that are part of larger real estate platforms that have the expertise on the equity side as well, and expertise with owning assets and the ability to take back an asset, are better positioned for some of these asset management challenges as they materialize. And I think also we're not expecting a huge amount of distress kind of at scale outside of perhaps in the office space, but there are certainly going to be a number of special situations and repositionings of capital structure that will present opportunities over the coming years.
Got it. Could you talk about how you at Affinius have shifted, investment in equity versus debt, and how that has changed, and maybe how you expect it to change moving forward?
Yeah, I mean, I think there are a number of opportunities in the marketplace today. I would say if you look at certainly the debt market opportunity that's presented itself, I think on a relative value perspective, we see a lot of opportunity, whether it's in filling that gap capital, whether it's in even first lien lending, given that rates are much more attractive today compared to where they were a few years ago, and construction lending as well, right? Because there are still deals that need to get to the finish line, or there's a lack of activity. And like I said, a lot of the other traditional sources have really pulled back from the marketplace, and that's creating some attractive spreads and attractive yields in the space. So I think the lending side of the business continues to show a lot of relative value and be an in favor sector. We are also very active as it relates to data center development. I think there's clearly a move to the digital economy, and the space has exploded. What's happening with generative AI and the sort of arms race among the major hyperscalers. There was one, if you look back to the beginning of the year, the four major players, Meta, Microsoft, Alphabet, and Amazon, had targeted about $180 billion of CapEx towards primarily building out their digital infrastructure in 2024. That's up 50% from where it was a few years ago. And if you listen to the Q2 earnings calls, they're only expecting that to accelerate. So I think there's just huge demand that really can't be fulfilled because of constraints on power in the market today.
Sure.
So we see a significant opportunity for continued data center development and partnering with those hyperscalers to deliver the scale that they need. And then I think on some other sectors, the market is shifting pretty quickly. I think over the last recent history, we have seen some, and we're seeing some opportunity to buy below replacement costs in industrial multifamily, given the dynamics of that space. But and particularly attractive given the lack of new product coming to market. But I think we continue to see strong demand for newer assets, new product in a lot of sectors that probably will lead to a lack of the right type of space that the tenants are looking for in the near future.
Sure. Well, we've been hearing a lot about that. Within CompStak, we've been focusing on a strategy we at least call internally, we call it our industrial plus strategy, which is to say we're focusing on making sure we've got great industrial data, but also the plus being everything else that everybody's looking at right now, whether it's data centers, industrial outdoor storage, cold storage, there's been interest in self-storage. Then there's some things that are a little harder for us to be able to add a lot of value in, like that have been hot lately, single family rentals and student housing and all sorts of sectors that were otherwise considered to be niche, no longer niche, right? I think that the trend towards diversification across the portfolios of our clients has been huge, and it feels like that's here to stay. The major food groups are no longer what's as critical to them as having good diversification, I would say, across their portfolios. What you're saying certainly resonates with what we're hearing over and over and over again. But it's interesting. But of course, there's so much, there's definitely been some good cyclicality throughout that time, right? Because we were hearing, obviously, a ton of interest in the last few years, previously around life sciences. That's certainly cooled quite a bit. Medical office was very hot. I wouldn't say that it's cooled a ton, but it's definitely cooler. There's, and certainly what do they call it, medtail, the medical retail with all the, there was an urgent care opening up on every corner, not so much anymore. But so you mentioned data centers. Do those sectors that I mentioned resonate as ones that you guys are pursuing, or are there other ones that I missed that are particularly interesting to you right now?
No, I think you captured it, right? I think for the industrial, there's some offshoots, I would say, that are related. I think probably industrial outdoor storage is a sort of a mix of self-storage and industrial, right? And a bit of a covered land play as well. But there are some very strong tailwinds in the industrial sector, right? Both from what we've seen longer term in terms of e-commerce, as well as I think newer development, post-pandemic has been a real focus on onshoring and nearshoring some of the key supply chains in the U.S. and the geopolitical environment. So from an e-commerce perspective, I think we've seen retailers building out their online capabilities. Amazon's now back in the market. They signed more leases in the second quarter than they did in all of 2023. And it's not just them, right? As retailers are building out their omni-channel strategies, that accelerated during the pandemic and continues today. And then I think the supply chain issues that we saw during the pandemic as well, and the geopolitical tinderbox that we are living through today, and more news on that front with what's happening in the Middle East right now. But I think a lot of retailers are looking to shift from a just-in-time to a more of a just-in-case type strategy on their inventory, and they've come to the realization that some slack in the system may not all be bad, and they need to be prepared to deal with temporary disruptions, right? So the U.S. government has fueled some of this. They passed some legislation like the Bipartisan Infrastructure Law, CHIPS and Science Act, Inflation Reduction Act, to promote North American manufacturing and supply chains. And so in the U.S., manufacturing and construction is now 3 times where it was over the past decade. And I think, like I mentioned before, a lot of these tenants are looking for high-quality modern logistics facilities. And so as that development cycle runs off, there's going to be increased tightness in that space, which should be a tailwind for fundamentals. But I think to your point, right, some of that pandemic strategy was things like cold storage. I think when there was an expectation that a lot of the grocers might ramp up their delivery activity as they did during the pandemic, and some of those trends have been more sustainable than others.
Yeah. So are there any sectors there that you think are overhyped?
That's a good question. I think a lot of things are cyclical. I mean, I think even with the life science space, right, I think to your point, there was some overbuilding in the sector for sure. But long term, we are generally, I think, believers in the aging of the population, and that those types of technologies and medicines are going to be highly in demand. And so I think eventually the market comes back. It's just going to take a while. And part of that was just the capital markets falling apart, right, for a lot of these startup companies.
Right. Yeah, there was a ton of venture funding going after these companies, and that dried up. There was, directly resulted in less demand for the space, and as that comes back, I think you're right. You'll see some recovery. But we've even heard, people have been thinking about how to repurpose office buildings. But I've even heard a conversation recently about repurposing lab space, which of course it's so expensive to build it out to begin with. So that's an interesting challenge. Why don't we dig into office a little bit? Actually, I mean, you mentioned you don't see a lot of meaningful distress except for office. Do you have any prognostications on what we see there? Do you think we've hit a bottom in office yet? And what do you see to come?
Yeah, I mean, well, your team put out a fantastic report on the office markets last week, so some of these statistics may sound very familiar to you, but I think we're all familiar with some of the struggles in the office sector, right? Vacancy rates are generally up across the board in most major markets, particularly in some of the CBD areas and coastal markets where you have employment concentrations in areas that are better suited to remote work, tech, finance, professional business services. So as we are, we'll put a pin in, there's a significant divergence in performance by asset quality, but generally speaking, right, post-pandemic, return to office has struggled. If you look at a lot of the third-party groups that are tracking it, Castle Systems on the card swipe data, or the Work from Home Research Group funded by Stanford University and Chicago and MIT, a lot of those measures have sort of leveled off in terms of the return to office over the last 12 months or so. But that's also because we've been in a very tight labor market, which has provided, I think, employees with a lot of leverage. And I think increasingly a lot of these third-party studies coming out would suggest that something we've probably known intuitively all along, but that productivity generally is lower in a remote work environment. And I think we're big believers that companies were in the office for a long time for a reason. And so whether it's idea sharing and network effects, mentorship for the younger generations, and just kind of hearing what's going on in terms of office chatter and people coming out of meetings, and from a productivity perspective as well, having that isolated ability to perform your work. And so I think we've long been a believer that return to office would accelerate with an economic slowdown, and that the softening jobs market we discussed earlier could be an impetus to start bringing people back to the office. So one very surprising statistic to me is that if you look across the top 44 markets in the U.S., total office absorption was actually positive in the second quarter, which is something we had not seen for a while. Certainly varies by market, and part of that is driven, by lack of new development. But Amazon, announced just recently that they're going to be doing full-time return to office
Right.
beginning in January, and that may be an impetus for other companies to follow suit. KPMG does a CEO survey that they perform twice a year, and if you look at one of the questions they asked back in April was, over the next 3 years, what percent of employees do you expect will be back in the office, and companies do you expect will be back in the office full time? And back then the answer was 35%. That increased to 80% back in the office full time in the September survey. So there's been seemingly a shift in sentiment in that space as well. So I think that's one thing. Now, one of the interesting questions, and your report does a great job of highlighting it, is there's a huge differentiation in office performance based on vintage and quality. So Class A, post 2010, modern vintage office with efficient space and the right amenities has single-digit vacancy rates, which is less than half of what we're seeing for the rest of the office market. And Class A rents for some of the highest quality assets, One Vanderbilt being a great example, continue to set records, right? So
Yeah.
for the employers that are able to offer those best-in-class space and amenities, that's been one way to lure employees back to the market. And what we're hearing from our people on the ground in some markets, New York being a good example, is that the best office is increasingly full. And so now we're seeing more touring activity as you move down into like class, A minus, B plus type space. So it'll be interesting to see how that plays out. And as more companies look to bring employees back full time, how are they going to try to compete with the type of amenitized space that I think employees are increasingly looking for,
Yeah.
and doesn't exist today. So.
Well, I'm a believer in the A minus B plus space. I would say that's kind of the kind of office that we're in, and it's interestingly, and for some reason, I guess maybe not enough people are taking the same strategy as we have. But I'm of the mindset I'd rather take more space in a little bit of a cheaper rent building, right? And be able to offer more amenities within our own space to our employees than take a smaller space in a more expensive building and share amenities or not have amenities. I mean, you actually look at a building like One Vanderbilt, there's actually not amenities really at One Vanderbilt. The biggest amenity at One Vanderbilt is that you're on top of Grand Central and you're in a brand new building. But it's not a big amenitized building, and then there's other buildings that, stand out because of their amenities, but maybe are in worse locations or new buildings. But I'm a believer in, take advantage of the cheaper office space, get more of it, and build out your own amenities and make it a great experience for your team, which I'm not quite sure why more people haven't taken that tack, but we'll see what happens. But for us, we use it as an opportunity to take space and build out a gym and showers for employees and a fully amenitized kitchen and all the things that people might want because we had the space to do it.
I've been out to your office. It's very nice. I agree.
Yeah. It's interesting. I think we'll see how that plays out. I think another thing that's worth kind of mentioning is that these trackers like the Castle data on return to office and things like that, they don't directly correlate to office occupancy, right? We continue to see more and more people return to the office physically, right? Per those kind of trackers, more people were coming in, and yet absorption, was going negative and increasingly negative, right? And I think what people didn't realize or aren't maybe fully recognizing is that there's been pent up demand for people to give up office space. The vacancy rates didn't plummet, at the onset because people were locked into long-term leases. But they made plans to give up those leases in the future. So people started coming back to the office, but people kept giving up space when they had the opportunity to do it. And now it would seem like we're getting to a place, okay, that's done. People who wanted to give up the space have now had the opportunity to do it. And now we'll start to see the net absorption come back. So, but the problem is that, it takes time for these leases to roll and for people to make those decisions. But
No, I think to your point, it's been that, and it's also been, as we come back or as many have come back to the office part time. If everyone's coming in Tuesday, Wednesday, Thursday, you kind of still need the full space for those 3 days to get everyone together. And even though you're only maybe 60% utilization of the space, you still need 100% of the space.
100%. And to be honest, I keep looking at the office data, and I've been continually, honestly, somewhat perplexed by it, because there are very few companies that I know of at this point that aren't back at least 3 days a week. And there's only 5 work days in a week. So if you're back 3 days a week, even if you can't stagger that, because you need 6 days to stagger and share desks. Not to mention the fact that employees hate hoteling and they don't like sharing desks. They want their own desk. And if you want to get people back in the office, you need to give them a place where they feel comfortable and they want to work from. So if you're in 3 days a week, to your point, it's the same difference as being in 5 days a week. So it's hard to understand why and employment, by the way, is still pretty close to peak levels. So how is it that we could have vacancy as high as it is? And I in my opinion, like the big sort of like the elephant in the room that isn't really being discussed that much is that these companies have lots of policies of people coming back to the office, but they are clearly allowing a ton of people to stay remote and not come back. And they may have whatever policies they have, but companies still have people who are permanently remote or semi-permanently remote, who they're allowing to stay remote, because that's the only way that these vacancy rates can be the way they are. Either that, or there's all sorts of companies that are fully remote, but that doesn't seem to be reflected in what we're hearing in the numbers. So I think it'll be interesting. I also think that those people who are fully remote are probably more likely than others to be laid off. More likely if they quit to not be able to continue to be remote when they go look for a new job. So I think I'm still bullish on office. I always have been, and that means that I will be wrong until eventually I'm right, because everything's cyclical. So it's cool.
And I think to your point, I fully agree with you in terms of there's. As the employment market weakens, it's going to be those people who aren't showing up that are probably first to be laid off and just aren't in front of their managers and aren't being seen, right, and not part of the team. So
yeah, and there's certainly speculation as it relates to the Amazon move that this is Amazon trying to do a layoff without doing a layoff. That they basically, the people who choose not to come will be back or self-selecting, and that allows them to cut their workforce without having to do it.
But I guess then on the flip side, there's still, I think that speaks to a lot of the higher quality office, but there probably are still a lot of class B-C buildings that are effectively obsolete, maybe call center type space where employees don't need to be back as often, and those are going to probably continue to struggle or need to be repurposed. Right?
Yeah.
So.
Yeah, I think that's fair, and it's interesting to watch what happens with those. And some can be repurposed, and some can't, right? Or to the extent they can. Some require a lot more money to make it happen than others,
Absolutely.
But we will, and certainly, obviously, we could go down a whole rabbit hole on the regulations needed and to allow for some of these conversions to happen, and some of the political, implications there, and all sorts of things. But we'll maybe save that for another time. Let's talk a little bit about technology and data. So maybe you could tell us a bit about how you leverage data and technology within the Affinius platform, and then we could talk about maybe some trends more broadly there.
Yeah, absolutely. So, I think throughout my career in real estate research, right, the challenge and the opportunity has been a lack of standardization and transparency of the data. So that's been the case since real estate became an institutional asset class, and part of what makes your business so valuable to us, right, in terms of the data transparency and the ability to get that. So, over the last 20 years, the quality and availability of data has improved dramatically. We still have a lot of disparate sources, right? Whether it's where we're getting the demographic, economic data, vacancy, new construction, rent fundamentals, lease and sales comps, lending data from all kinds of different sources, right? The Fed, Federal Reserve, ACLI, TREP, et cetera. So, and now with the rise of the alternative sectors that you brought up earlier, right? It's even more disparate. Where can we get fiber, substation and transmission lines, land parcel data, single family residential transaction data. And so, with all kinds of alternative data sets now to explore, like mobility and cell phone tracking data, Google Yelp reviews, all those kinds of things. And increasingly, our internal data as well, right? How can we most effectively and efficiently capture that data? So I think the challenge has moved in a lot of ways from how to get data to how to assimilate all the data and achieve actionable insights. There's no Bloomberg terminal for real estate, and so how can you kind of assimilate all this data and get actionable intelligence? And we created our platform with sort of three principles. One was to take all of this valuable, third-party data and try to get it onto the same geospatial analytical framework, right? So how can we automatically update through, AWS has 3 buckets, APIs, et cetera, and then combine that with our internal documents as well and all the data that's flowing through our internal team. And that's an area where I think some of the large language models and deploying those for customized internal uses really have a lot of power and are enhancing our capabilities. So that was kind of one, is to kind of put everything on the same geospatial analytical platform and make it easy to have the data speak to each other. Second was to make that accessible to our internal teams. So whether that's, a lot of our data initiatives revolve around working with our development teams, with our investment teams, lending teams, asset management, et cetera, to make sure that we're getting the right KPIs, that we make it easy to access so that, our development analyst doesn't have to log into vendor 1 and vendor 2 and vendor 3 and pull down 3 different types of reports and try to pull it all together, but hopefully go into our platform, type an address, and we've at least tried to pre-package some tools and some proprietary analytics to help them with the decision-making process. And that's kind of the third part of it, is how can we create tools that are intuitive and easy for the team to use, right? So whether that's using, geospatial framework and heat mapping to kind of quickly pull up a market and see, hey, where's the density, where are the incomes, where are the job growth, et cetera. And then other modeling techniques to, determine what drives results. So to quote, Buffett, all models are wrong, but some are useful. That's Warren Buffett, not Jimmy. But I think a lot of our models are looking at kind of separating outperformance from underperformance. We know that, if we say this area of the market's going to get 5% rent growth, a lot of that depends on macro conditions, et cetera, but it's really about where are the top performers, where are the bottom performers, and how can we make that separation.
Do you think that you will be making purely model-driven investment decisions at some point?
I do not see that at any point for the foreseeable future. I think, there are many challenges with the data that I outlined earlier in terms of imperfect data, lagged data in a lot of cases, right. And then I think we are still very much a relationship-driven industry as well, and you have investment professionals here that have many years of experience and have seen parts of the cycle, and I think to your point, don't want to get over our skis just because the data is telling us something that may not be the reality on the ground.
Yeah. So. Well, we have a client that is using a model to make their investment decisions. Particularly within industrial, they still have analysts that are evaluating these opportunities. But if the analyst's decision on whether they want to move forward on an investment and the way they underwrite that investment falls outside of a range for which the model has determined that they should pay for that asset, they have to get more explicit approval to go beyond the scope of what the automated model has laid out for them. So we're seeing, at CompStak we call that kind of thing like a human in the loop model. I think we're seeing a human in the loop model to real estate investment where it's sort of it's the model and the technology working hand in hand with some of the instincts of the real estate investment professionals. I'm
No, I
curious.
think that's exactly right. Yep.
Yes.
I mean, I think that's a very, in some ways similar, right? We're using some of these techniques to inform our underwriting process, right? Whether it's the timing of lease up or the number of units leased per month for a new development for multifamily, or whether we think this asset may be an outperformer or underperformer from a rent growth perspective. And then to your point, right, there are certainly cases where we can come in and say, all right, but here are the reasons why we think this is misdirected or this is what the model's missing. But you do need to. It helps to have a more robust discussion.
Yeah,
Topics.
yeah.
Right.
And to your point on things like lease up or for instance, or probability of renewal or like right and things like that, like people just plug in the same numbers over and over again. They'll build an Argus model and the probability of renewal is 50% across the board. And it's like, you don't need to do it that way. You can look at your existing data. You can look at data in the market, and you can analyze what percentage of the time do people renew, and what percentage of the time do they expand, and by how much, really actually look at real data to drive these things. You don't need to just plug in bullshit assumptions.
Yes.
We hope that our clients are becoming more sophisticated in the way they think about those things.
Well,
I'm curious.
Your data is a great example, right, where you can actually look at and it changes over time, right? The renewal rates for office today are not what they were 20 years ago.
Of course.
Right? And so you have fresh live data where you can kind of say, okay, in the last 2 years, 5 years, how is that? How are those renewal rates trending? And it varies, of course, by market and type of tenant, but helps, definitely inform those decisions.
So now is the time when you give us your full secret sauce to everything. So, I'm curious actually if you'll tell us, in particular, and aside from CompStak, because that's the obvious, are there certain like data sets that you're really excited about as far as leveraging in the decisions that you're making, certain technologies that you've been leveraging that you think are interesting to talk about and other people should look at, or do you not want to talk about them at all because it's your secret sauce?
Well, probably a little of both on the answer for that, but no, I think what's exciting and what the technology enables is when I talk about a geospatial platform, whereas previously, I think historically the industry is heavily focused on markets or sub-markets, and then you have the expertise on the ground to bring you to what are the advantages of the neighborhood, right? Or where is the demarcation of the sub-market or micro-market? I think a lot of the way that the data has developed, it now kind of enables you to query at scale from the top down on a much more granular micro-market level and assess trends from that perspective, right? And I think that's where some of the leading, big data techniques, whether it's machine learning, random forest, neural network type models, are really efficient at processing those kind of analytics at scale and finding information. And some of that, of course, most of the time, or a lot of the time, it is somewhat intuitive in terms of what are the drivers, and sometimes it's not. And you want to make sure that, from a garbage in, garbage out perspective, right, you're really being careful about what you put into these models, so you're not getting false positives or mixed results. But I think that there's a lot of opportunity from that perspective to really, run these analytics in a new way and get additional insights that weren't available previously because you just weren't able to process those types of analytics at scale.
So when you talk about a geospatial model, are you saying, or platform, are you saying that what you've built is on a map, or are you saying that you're using characteristics of location to do modeling, or a little bit of both?
I think it's a little bit of both. And so, if we think about those sources that we talk, for CompStak data, right, it's fairly straightforward because you've got a latitude, longitude, or a place for each building. We've talked in our advisory board meetings about some of the challenges of dual address and things like that. But I think for the
Right.
most part, it's fairly cleaner to put that on a map, and a lot of the real estate data can operate that way, where we're able, again, I think compared to where we were 20 years ago, there's a lot better asset quality information available. From a demographics perspective or employment perspective, or from a built environment perspective, I think some of it you need to create, there's an opportunity to create your own structure, because there's not necessarily a existing third-party tool that makes it easy to import all of your various data sets and create those type of analytics.
So maybe you could tell us what your expectations are for the next year and a half on lending volumes and just generally where the market goes.
Yeah, well, I think like I said, crystal ball is not always perfect, but I think we have seen a lot of positive trends here. I think in the last 4 to 6 weeks, I think there's a general feeling in the marketplace that that bid-ask spread is converging, and I think that's going to really hopefully drive some increased activity here over the next 6 to 12 months. I think we're already seeing the activity in our all parts of our business, right? Whether it's acquisitions, lending, development. I think the deal flow and the bid has changed materially from where it was a few months back. And so, I think if the expectations of what's in the forward rate curve, or what Chairman Powell identified yesterday in terms of continuing to lower rate, I think that's going to continue to bring the expectation of where people have thought for some time that rates are headed with the reality, and mesh that. And I think that is going to continue to, I think restore some of the health of the marketplace. I think a lot of investors feel we've hit the bottom in terms of pricing, and that we are now coming back up. And I think that's reflected, certainly in the REIT markets, but I think for the other sectors, we've already seen that leveling off. And I think there's a general sentiment that we're going to start to see, values flatten and maybe even start to grow here over the near term, which again will close that gap and get activity moving again. That's been kind of locked down for the last couple of years.
Awesome. So what advice do you have for our listeners? And let's assume our listeners care about commercial real estate. So maybe not parenting advice, although you could give that if you want. Maybe not horoscopes, but maybe something related to, real estate investment, lending, developing, asset management.
Well, I think it's, far be it for me to offer advice necessarily to the marketplace, but, I think, like I said, those are the kind of the metrics that we're watching. And, I think what's exciting is part of what this, from a research perspective, what this slowdown has enabled us to do is to put even more time into building out our capabilities and our systems and our analytics, so that we are ready here as the market begins to accelerate to take advantage of those opportunities.
Nice. Well, I love that approach. It's a good time to build and be able to take advantage of all of this. And I'll lay in my advice, I suppose, to that, which is to say that in my somewhat limited but not that limited experience in the commercial real estate market, I'll just say that as was mentioned earlier, in our conversation, my thought is everything is cyclical. And as I hear you talking about what's hot and what's not, the only thing that seems sure to me is that whatever is very hot now won't be in the future, and whatever is very much not in favor will be in the future, at some point. And I've been through, a bit in this market to see that happen. And, actually all of us have, right? I mean, if we were having this episode or this conversation in, 2019, we'd be talking about how retail is dead. And then in 2021, we talk about how retail is now really dead. And now we didn't even talk about retail today, but retail today is not dead at all. And, if we were talking after 9/11, we'd talk about how nobody is interested in office space and big, tall office buildings. And that's now very much the opposite. So I think, my thoughts in hearing about these different sectors is just, everything old is new again, and it's all going to come around. So let's see what happens. Well, thank you. This has been fun, and really appreciate you taking the time to chat with me.
No, it's been a pleasure, and thanks for having me on. And it's great to chat with you, Michael.